Hello, we are going to discuss the subject of balance of payment today. We have already discussed the theory of international trade, factor endowments, terms of trade, and gains from trade. We have seen and discussed that once a country is doing international trade in certain commodities, goods, and services, its standard of earning and its standard of living are both going to improve over a period of time. Because by doing international trade, particularly when a country exports goods out of the country, it is going to earn foreign exchanges. Dollars if you are exporting to US, pounds if you are exporting to UK, euros if you are exporting to European Union. But at the same time, if you are importing commodities from United States, you should be paying the dollar to them. If you are importing from United Kingdom, you are going to pay pounds. If you are importing from Japan, you are going to pay yuan and yen in that order. So what happens is, whatever earning is coming through because of the exports that are going to take place is being spent on payment made for imports. If your exports are more than your imports, on those circumstances, the imports being less, you are earning foreign exchange surplus. Balance of payment denotes these plus surpluses or negativity in earnings. We are going to discuss in detail the balance of payment, disequilibrium, adverseness of balance of payment, and all. The terms balance of international payments usually refers to balance of payments BOP. Is a systematic and summarization of records of a country's economical and financial transactions with rest of the world over a period of time, suppose say a financial year. It is a systemized procedure for measuring, summarizing and stating the effects of all financial and economical transactions. So when I am talking about exports and imports, these are for goods and services which are happening in the market, in the international market. So you are either earning foreign exchange or spending foreign exchange. But these monetary values are in case of financial and economic transactions. Unless something is of economic value and the value is capable of being stated in terms of financial terms, it cannot enter the balance of payment transaction. These transactions include exchange of goods and services. There may be loan transactions, a particular country taking a loan from one country or making a repayment, gifts and grants received from other countries as helps for building infrastructure, short-term and long-term and portfolio investments. For example, while the Delhi government tried to build Delhi Metro in the early 2000, it was found that the cost of building Delhi Metro, a network of 300 kilometers within Delhi, is coming to be 60,000 crores in the prices of 2003 to 2005. But who is going to finance that kind of money? When you looked internationally, you found that a certain Japanese Bank of International Reconstruction, is actually willing to spend and give a soft loan at the rate of 2.5% for the next 30 years to Delhi Metro Rail Corporation. Till now, till at this point of time in 2012, they have almost extended a total loan of 27,000 crores at the rate of less than 3%, which will be repayable till 2030. So that's a grant which will be utilized by one country for development of large scale infrastructure. A transaction in the course of balance of payment is either being recorded as debit or credit depending upon the direction of the payment. If the transaction results in a cash outflow, it is debit. If you're paying it when you are in the course of imports, that is a debit. If the transaction results in a cash inflow, it is recorded as a credit. That is when we are making a transaction in regard to exporting something. If we are going to receive some money from exports, then we term it credit. The International Monetary Fund Balance of Payment Manual describes the concept of balance payment as the balance of payment is a statistical statement for a given period of showing transactions in goods and services and incomes between an economy and rest of the world. So this is about transaction of goods and services and income between an economy and the rest of the world, because we are not going to trade with one country only, we are going to trade with many countries. Changes of ownership and other things in that country's monetary gold, special drawing rights which is reserved with the International Monetary Fund, and claims on liabilities to the rest of the world. The unrequited transfers, that is the unilateral transfers, and counterpart entries that are needed to balance in the accounting sense, because total amount of debit must be equal to total amount of credit in all senses all the time. So the entries for the foregoing transactions and changes which are not mutually offsetting are also includable in balance of payment. We are going to discuss all those items, all those accounts one by one. The format of the balance of payment is given below, shows that the transactions entered into balance of payment account is divided into following heads: current account, capital account, unilateral payments account, and official reserves account. First of all, we are undertaking current account. The current account includes all the transactions which give rise to national income. The current account consists of two major terms: merchandise exports and invisible items. Merchandise exports and imports can take the form of visible goods. Invisible exports and imports are about services. In case of merchandise exports, the credit entries because of sale of goods abroad, when you export the goods, that is a credit entry, because it will have a monetary claim on foreigners representing credit. On the other hand, when we import merchandise, which means we are purchasing goods from abroad, these are all debit entries because all the transactions are giving rise to foreign money claims, which means in case of imports, outsiders has monetary claims on us. So these represent debit. The merchandise imports and exports are the most important international transaction of most countries. They form 60-70% of total balance of payment of the country. Next comes the invisible exports. The invisible exports are called services. The sale of services, that's the invisible exports, are all credit entries, whereas invisible imports, that's the purchase of services, are debit entries. Services includes transport, insurance, tourism, payment of dividends to outsiders, NRIs, foreign institutional investors. So when we spend money outside on purchasing goods and services, that is a debit because that amounts to imports. Similarly, when foreign countries, the citizens of foreign countries, the foreigners purchase services from us, that constitutes invisible exports. So that's credit entries for us. One of the largest source of invisible exports is the software exports that India has come to be known for all over the world. Software exports has emerged as a very important invisible item of India's current account. Components of BOP on current account, you can see that the visible items are balance of trade, BOT. BOT is export of goods minus import of goods. Obviously, goods are visible, that's the physical items. But the next term is a balance of invisibles. Invisibles are services. So balance of invisibles would be export of services minus import of services. So balance of payment on current account would be balance of trade plus balance of invisibles. By adding them together, we'll have balance of payment on current account. Next we come to the capital account of the balance of payment. This is the second nominal heading. The capital account consists of short-term and long-term capital transactions. Capital outflow represents debit and inflow represents credit. For instance, if an American foreign institution invests $100 million in India, this transaction will be represented as a debit in US balance of payment, but at the same time it will be noted as a credit entry in the balance of payment of India because we are going to receive the money in any way, but that's a long-term liability. Payment of interest on loans and dividend payments are recorded in the current account since they are really payment for services of capital. As already been mentioned, interest on paid loans given by foreigners are debits in the home country in the balance of payment current account and credits in the foreign country balance of payment capital account. We can summarize this into three headings: foreign investment, FDI by foreigners in India minus FDI by Indians abroad, balance of payment we are calculating from the point of view of India, portfolio investment by foreigners in India minus portfolio investments by Indians abroad, then loans. There are three types of loans: external assistance, commercial borrowing, and deposits by NRIs. External assistance by foreigners in India and by Indians abroad. Commercial borrowings by foreigners in India and by Indians abroad. Deposits by NRIs, fresh deposits by NRIs in India minus withdrawal. So foreign investment is point 1, point A, portfolio is point B, and loans is point 3. By adding all the three, A plus B plus C, we calculate balance of payment on capital account. FDI, the first part of the discussion. FDI occurs when a foreigner sets up or acquires the control of production units in India. He or the institution is investing into setting up of a new business, or they have invested money into an existing business. The foreigner transfers from his country funds into India, so thereby making it a credit entry. So such transfers constitute credit entries in the capital account. Similarly, portfolio investment constitutes transfer of funds between nations to acquire financial assets. For example, if a foreign institutional investor purchases stocks of Reliance Industries on the National Stock Exchange of India, foreign exchange will flow in. So that's a portfolio investment because that is not a direct investment, it is an indirect investment through the stock exchanges. So it will be treated as a current capital account credit entry in the balance of payment. The balance of payment is just the sum of two accounts and it's calculated as follows. The balance of payment is equal to current account balance plus capital account balance. The sum of these accounts should always be zero, which means if one is plus, the other one should be negative. So both of them carries in opposite direction and should be equal in terms, in volume. If the two accounts are not equal, then there is a discrepancy in the balance of payment. Then a resort is made to the reserves of the foreign exchange available with the central bank of the country. In case of India, it is the Reserve Bank of India. So money is withdrawn or deposited for the balance. The next heading is unilateral transfers. Unilateral transfer is another term for gifts and includes private remittances, government grants, reparations and disaster relief. Unilateral payments received from abroad are credits and those made abroad to outside countries are debits. So these are gifts and grants that we discussed. These doesn't have any commercial replacements because in case of a natural disaster, if Japanese government, if European Union gives us $500 million for the rehabilitation and relief of those people affected for a natural disaster like an earthquake, that's known as unilateral transfers. The next is official reserves account. Official reserves represent the holdings by the government of a country or its official agency like Central Bank of India of the means of payment that are generally accepted for the settlement of international claims. These are accounts which are maintained by the government for contingent liabilities, for settlement of internationally accepted contingent liability principle. You can see here the balance of payment data. We have taken the data from 1990 to 91 and till 2004 and 5 September. In 1991, before the globalization happened in India, Indian economy was almost a closed economy. Foreign direct investment was not forthcoming to India because of its closed relationship. Under the stewardship of Finance Minister PM Manmohan Singh and PV Narasimha Rao, then Prime Minister, Indian economy was open to outside influence. But before that, the exports were mere 18,477 US million dollars and imports were almost 50% more. The balance of trade was minus $9,400 million. Invisibles aggregated minus, so services was not that strong sector unlike now. Current account balance was minus 9,680. Capital account balance was 8,402. Thereby, India's balance of payment was naturally in negative. But in 1997 and 98, the situation improved drastically. Exports become almost double, imports have slightly come down, trade balance is still very large in negative terms, but overall you found that there is a surplus amount in the BOP. The thing continued. You can see that both the invisible services are negative in terms in 97-98. But in the year 98-99, even if imports decreased very radically, invisible items grew. Instead of being negative 10,000 crores in the previous year, they increased tremendously to be positive 9,000 crores. Because of that, there was a dramatic change in the balance of payment situation of India. In 2001, in 2000 also, it grew. And right now, in 2003 and 4, it's 26,000 plus. I have not included the current data, but as far as I'm concerned, in the year 2010 and 11, the net income from the invisible trading is around 60,000 crores. There is still a gap between exports and imports. The balance of trade is still negative, but it has come down drastically. The table reveals that India's exports has increased by an whopping 81% during 97-98 to 2003 and 4. It has increased from 44,703 million to 64,723 million dollars. There is an increase of 81% during a period of 6 financial years. That's a large increase considering Indian economy was largely agricultural till 91-92. Indian major trading partners in these 10 years were USA, United States, United Kingdom, Belgium, Germany, Japan, Switzerland, Hong Kong, United Arab Emirates, China, Singapore and Malaysia. You'll find it surprising that Pakistan was not of the largest trading partners with India. The Economic Survey of India, which conducted in 2004 and 5, reveals that export registered an increase of 25% in 2004 and 5, substantially higher than 11.7% which was recorded in the previous year. So export is increasing at a rapid rate. Exponential growth is there. In foreign policy draft of 2004 to 2009 for 5 years, the government fixed an ambitious target of $150 billion of exports by the year 2008 and 9.